What's up?
Hello.
How you guys doing?
It's fun being here in person in New York together.
Absolutely, the Big Apple.
It's good.
Go Knicks.
Go Knicks.
Oh,
Tough night last
are y'all
night.
heartbroken from
A
last
little
night?
bit. Yeah.
Oh.
As a
It's okay.
Cavs,
We got another one tomorrow.
as a Cavs fan, it was Schadenfreude.
Knicks and 6.
Yeah.
Knicks and 6.
All right.
It's okay. We still got tomorrow. Okay, so today's episode, as y'all know, is building off of last week's episode where we talked a lot about equity markets and what equity markets are doing, especially how equity markets are booming because of AI. Now we have to answer the question, because our entire podcast is about digital finance and Web3 and not necessarily crypto, but is crypto still relevant in the age of AI? And so first, I think we need to kick off by defining, what do we mean when we say crypto? Because that's different from a lot of the other things we talk about on this podcast. So I want you both to take a stab at it, and whoever wants to go first, go for it.
Oh, go ahead, Ian.
So I broadly categorize the infrastructure upgrade in finance as digital finance. I think if I was to define crypto as a specific subset of that, I would think about it as independent L1 blockchains. And so those would be Solana and Avalanche, Ethereum, maybe Bitcoin, Algorand, et cetera, et cetera. There's been many, but I think when we think about crypto specifically, I think about it as the alts broadly, and then Bitcoin sort of as its own thing. But I think that's a subset of blockchain technology. I think it's a subset of Web3. So that's how I would think about crypto for the purposes of that question, which I really think what we're getting to today is the market cap of those blockchains has gone down pretty aggressively in the past year, as the value of a lot of the other parts of the technology sector have gone up considerably. And so I think that's sort of the question of the day.
Yeah, just to add on to that, I think the inspiration for today's episode was we spent last week talking about these mega IPOs that are about to go off. And generally speaking, tech and AI have ripped this year. Like the, semiconductor indexes, S&P, NASDAQ, everything's up big time. And then the crypto we're talking about today is, crypto as an asset class. Bitcoin, Ethereum, the altcoins, the tokens that you read about in the news as an investment, right? So the stuff we talk about on tokenization and stablecoins and like the utility of those technologies as applied to mainstream financial services, we're going to carve that off, right? And we're going to talk about crypto as an asset class. So Bitcoin, Ethereum, and that market has not done well, to say the least.
That's an understatement.
Yeah, if you look at crypto Twitter right now, it is a dark place. Let's actually we'll timestamp this for posterity. Let's see what the market's at as of the recording of the show. We've got it's 1:59 p.m. on June 9th, and we've got BTC at 61,000. The last time Bitcoin was at this level was, quite a long time ago, right? So we've got maybe August 2024. And this is a return to levels that we sort of touched in November 2021, right? So if you bought in November 2021, you've seen 0% gains as of today.
If you're a long-term holder.
If you're a long-term holder,
Yes.
right? And if you bought at 100 or 120 or 130, we just saw 130 or whatever, not 6 months ago, October 2025. We were at, it hit an all-time high. And so we're down, half of that today.
Yeah. Okay, I want to get into like Bitcoin as an asset. I think it's important for us to dig a little bit more into that. So Bitcoin as an asset and alts, and what we mean when we talk about alts, because that is a huge part of the crypto market.
Right.
But I do think it's important to just reframe what both of you guys said. So when we talk about, when the headlines talk about crypto, they group everything together. What we're saying is there are distinct buckets.
Yeah.
You have stablecoins, tokenization, infrastructure. You have the plumbing, the blockchain rails that Wall Street's adopting in one bucket.
Right.
That's where most of us live.
Yeah.
Then you have Bitcoin. And then you have everything else. And then you have a lot of what's happening
The
in
alts and the
alts.
apps that sit
The
on those
alts and all, the apps that are happening on that. I think DeFi probably sits in that one too,
Yep.
right? Okay. Although we've talked about how DeFi is kind of making its way into the first bucket. So break that down though. Like, why is Bitcoin different from alts? And how do people look at these as like a different asset?
Let me jump in and talk about why the alternative L1 blockchains have traded so poorly.
And L2s, right?
And L2s.
Yeah.
It's the L1s and the
Just
L2s.
cryptocurrencies in general.
Yeah.
Cryptocurrencies, look, meme coins are sort of a gambling speculation. Let me buy and get out before everybody else starts getting out. Fine. Meme coins are clearly speculative with a little touch of community and some capital aggregation.
And when you say meme coin, just for our audience,
meme
we're talking
coin
about Trump coin.
well, Trump coin would argue that it has some utility. True meme coins are proud of having no utility and really are a gambling mechanism. Pepe, things like that. Doge, things like that. Okay, so when we think about L1s and L2s and these blockchains and why have done poorly, despite the hope of them as the infrastructure layer for finance and identification and many other digital utilities, I think the answer is pretty simple and pretty fundamental. Blockchains sell block space. The demand for block space has underwhelmed the supply of block space. Too many blockchains selling too much block space and too little of a demand for people to record things on those ledgers and thus pay for the creation of those blocks is a fundamental macroeconomic fact. People have said and tried to compare the CapEx investment in the AI space to the dot-com bust. And the argument from the AI bulls has been, well, in the dot-com bust, you had dark fiber. Lots of infrastructure built, lots of capacity built, and just not enough internet-related demand to fulfill that supply. And so we had a cratering of the internet stocks before eventually the demand came. I think the AI bulls are right. That doesn't say we're not going to have a CapEx bubble there, but they are broadly right that there's no dark fiber in AI, that all the AI capacity that can be used is being used. The chips are being bought and put to work. The energy is being consumed. So I do think that the AI bulls, though, will eventually get out over their skis from a CapEx perspective. They are right that it's different than the internet dark fiber analog.
Well, as we talked about last week, there's real cash flows behind that too, right?
So,
these companies are making
100%.
hundreds of billions of dollars
100%.
in revenue.
Where I was going with that is I do think that the issue for blockchains, L1s, L2s, crypto is very similar to the dark fiber problem of the internet, where you've put out a lot of block capacity, you've invested in a lot of that for decentralized finance, and there's not been sufficient demand to ride those rails. And so you're not seeing the usage, you're not seeing the revenue, and you have a lot of stranded blocks or block space, the way in the internet bust, you had a lot of stranded capacity and fiber. So I think that at the most fundamental level, we've not had enough demand for all of the L1 blockchains. There are a lot of blockchains, a lot of L1s, a lot of L2s, relatively low barriers to entry to create this utility, to create this capacity, and there has not been the demand to meet it. And as that realization comes to the fore, you're now seeing a second wave of block capacity coming from the corporate blocks. And so those are the PayPals and the Circles and Coinbase has got a blockchain, and these are all major corporates who are now adding to the supply of block capacity at a time when insufficient demand has resulted in a crypto winter. So
let me ask though, do you think crypto prices are really driven by the fundamentals?
Ultimately, yeah. Yeah, sure. I do. I think where you've got now, you have some really good tokenomics. A good example of tokenomics that have worked with really good fundamental demand and the token has traded well is Hyperledger. I mean, Hyperliquid. Hyperliquid has been very successful. When people use the network, their fees are used to buy back the token and burn it. Those tokenomics have been phenomenal. But why it's worked is there's been a tremendous amount of demand for the capacity of that network to transact.
Last week, I was looking at some of the prices like leading up to this episode and doing some research. I listened to the Bankless guys. Of course, they talk about this a lot. But last week, when everything was down, there were a few tokens that were up. Mm-hmm. And all the tokens that were up are actually have revenue models that are working. And so their question was, hey, is this just a maturity of the market that now crypto traders are actually saying, hey, you actually have to have fundamentals for us to care. So it was either fundamentals and revenue, or it was there's somehow touching AI.
Yeah. So I think just let me take a second to explain for the audience how those fundamentals work. These tokens that we're talking about are used to economically secure these blockchain ledgers, either through proof of work like Bitcoin or proof of stake like Ethereum or like Solana.
You might want to explain what that means.
I'm going to explain. Yeah,
okay.
I'm going to explain why that's the case. Essentially, let's take Ethereum. What Ethereum requires people running validators to do. Validators are the computers that confirm transactions and uphold the security of that ledger. They require validators to put ETH, to post ETH, essentially as collateral. And in exchange for locking up that ETH, they give you a chance to earn fees from processing transactions. Why do they require you to post ETH? Because they assume, correctly so, that if you post all this ETH, which is supposed to be quite valuable, and then you act maliciously as a validator, you post bad transactions or you don't validate transactions correctly, that you can lose your ETH, either by destroying the network and destroying the value of ETH, or being slashed, which is this idea of being penalized for doing something. And so what Ian's saying, and this is what the blockchains would say if they were pitching the fundamental value of why their token will go up, they'd say more people will use the network, meaning validators will earn more fees, people will buy more ETH to post more and more ETH. So it'll create this demand for Ethereum because running a validator is going to be a good business model. I think that that's a world that all the L1s wished we live in, but I think that crypto prices go up primarily because of a speculative mania where people are buying them because they think they'll go up. I think that 99% of, maybe not 99%, of where the buy side was coming from that drove asset prices to these levels. Had no idea like what block space was, or like what proof of work was, or what proof of stake was. They're buying it because they wanted it to go up. And so the argument from the L1s has always been that, no, there are fundamentals behind these things. Because if what I said is actually true at the core, then you have a tool mania, right? You're just basically, you're just selling to the next sucker and getting out.
Do y'all ever read, he's formerly at Redpoint, now Theory Ventures founder, Tomas Tungs. No. So he's amazing, and he digs into all sorts of data, and then he writes about it. And for a long time, he was writing about Web3, and now mostly he writes about AI because that's where Theory's spending a lot of their money. In 2022, January of 2022, he came out and he did like a deep dive into what crypto prices were and why they were that. And so he ran all the L1s and over a few metrics. One of the top 3 indicators of how that L1 was being priced in the crypto markets was Twitter followers.
Mm-hmm. Definitely.
Well, these are network effect ideas, like, because that's not totally without its rationale, right?
I don't think it's bad, by the way. Go ahead, though.
But if you take Twitter followers, the idea of these blockchains is to create a network, like your telephone, like the internet, et cetera. It's a network among where the growth of that network is one variable and the usage of that network is another. There's only so much usage you get if you don't have a big network effect. So how much do I use my telephone as a function of how many other people have telephones? So one metric could be, well, we all have telephones, like we all have MetaMask wallets, but if nobody's using them, then it doesn't matter how many people have a telephone. If nobody's making a phone call, it doesn't really matter. So that it's certainly important to appreciate usage and certainly important to appreciate network effect. We're just not seeing the usage. And I think the concern now is, from a speculative perspective, is when we see the usage, are we going to see the usage come more from select number of heavy usage applications like Hyperliquid, or when we see the future networks grow, the usage will accrue to them as corporate networks because Coinbase has a built-in user base, because Circle has a built-in user base with USDC because PayPal has vendors doing transactions, et cetera, et cetera. And now, so I think to your point, there's been a lot of speculation that's now gone away because because we haven't seen the usage times the network effect, and now we're seeing more fiber, if you will, come to market in the form of these corporates who are well heeled. These other independent, let's call it non-corporate L1s, have spent a lot of money, have used a lot of their emissions to buy traction, and they haven't gotten the traction. And so now they're to some extent out of bullets at a time when very well heeled competition is entering the market.
And that's one of the, I think, questions that we had when we decided to talk about this today, going back to your intro, was look at the market. So historically, initially, Bitcoin was a contrarian bet. So it was it started as digital money, right? And then it evolved into sort of digital gold that was supposed to be uncorrelated or inversely correlated to fiat markets. And then it came back together with the institutionalization of Bitcoin and the ETFs with tech. It just became like any other risk asset. And like on any given day, NASDAQ and Bitcoin would roughly follow each other. When people are risk on, they're buying Bitcoin. It just becomes part of their risk allocation. And not just Bitcoin, Ethereum, Solana, other crypto assets, the majors, right? Why then today, when we have the most crypto-friendly administration in history by far, we have a lot more, like the SEC is not trying to sue companies to the ground, and the Department of Justice is not trying to put crypto founders in jail like full time.
And we have use cases that span beyond just DeFi and crypto.
Yeah. We have real use cases like stablecoins. And then the market, the risk assets are, I mean, today was a tough day. We'll see, it'll rebound, right? Let's all buy the dip. But generally speaking, risk assets, AI stocks, tech stocks, NASDAQ 100, QQQ, whatever you want to say, are up big time. Why is crypto so down? I have a few theories. I want to hear everyone's theories, but that was like the core premise of why we want to talk about it today.
Yeah. So, sorry, go ahead.
I was going to say, let's jump into theories.
Yeah. So look, I think one theory is when momentum things don't perform in the market they're supposed to, momentum traders sell. Mark Cuban made comments. He sold all his Bitcoin because it didn't work as well as gold in a flight away from fiat scenario. There's certainly a big cohort of that. There's a lot of the market is now held in ETFs, which are much easier to sell. Those are not the same diamond hands that they were. I think Bitcoin will be, arguably, if you were to design Bitcoin today, you would design it with better technology than what Bitcoin has. Every Bitcoin maxi will tell me that's not the point, but it is.
Dig into that a little bit though, because we still haven't really defined Bitcoin as an asset versus alts as an asset.
Bitcoin had the first mover advantage, has a finite amount of supply, has the best decentralization network. And we should say that on the point of decentralization, the market has not viewed decentralization as part of the blockchain trilemma with the same earnestness that I think maybe original cypherpunk Bitcoin maxis would have expected.
Definitely not.
So let me take a bit of a detour here. So the blockchain trilemma is speed, cost, and decentralization. There have been very successful blockchains like Hyperliquid, like Canton, like Solana, that have prized other variables. Privacy may be now a fourth part, so maybe it's a quad lemma now, but historically it's been a trilemma of speed and price and decentralization. Bitcoin has the great decentralization, terrible speed, not great price.
Cost. Or fees.
Cost, price, however you want to think about fees.
Yeah.
If you were to build it today technologically, you'd want to preserve the decentralization, but you could probably do better on fees and you could probably do better on speed. Probably. So coming back to this point, Bitcoin sets aside because it was never really built for smart contracts. It was never really built to be something other than a store of value, of internet digital money that wasn't pegged to any fiat currency. And But if you built it today, you might build it differently. It was built a long time ago in technology terms, almost 20 years ago, which is a lifetime, as we all know. The other blockchains have had varying degrees of decentralization to cost and speed. And I think one of the things that is very notable is the market for the past, if I'm wrong, 4 or 5 years has really said we care a lot less about decentralization and we care a lot more about speed and a lot more about cost. And I think that may change when we have a big hiccup in the global economy again. That may change when overbearing governments find a way to shut down more centralized blockchains. But that's the story for another day. For now, the decentralization,
let's say value or feature.
Value, yeah. And,
yes.
the ethos, that's what I was looking for. The ethos of decentralization has taken a back seat to the more commercial and quasi-pragmatic concerns in the
I think what we're saying is we don't think people are choosing blockchains now when you have hundreds of blockchains to choose from. People are not choosing blockchains because of how decentralized they are.
No.
That is no longer like one of the main reasons, especially on the institutional side.
And the point, Ian, that I think you both are hitting on is that Bitcoin sits aside in a different category from Ethereum and Solana and the others. I think for me, primarily because of like economically it's different, where literally Bitcoin requires massive amounts of energy and compute to mine Bitcoins. So you can think of it very analogously to like an actual gold mine, where you have like these huge physical input costs that are correlated directly to your output. So like if you hire like 1,000 people and a billion, 1,000 diggers, and you spend $100 million on equipment, you should, with some degree of success, be able to say that will extract X amount of gold from the ground, right? And so Bitcoin's a little bit like that. The others are very much driven on usage of their network. Exactly. So it's like usage generates fees for the validators. And so economically, they're quite different. And yes, the idea of scarcity. But for this question, the assets are acting the same. Like the alts are down worse, but they're all down, right? So I don't see the market like, yeah, there's a little, I think the differentiation in the price has to do more with just Bitcoin being first and having the most institutional adoption and a little bit of like staying power.
I think there's some narrative.
Yeah, it's the first.
Do y'all buy into the Bitcoin as a store of value narrative?
I'm not a Bitcoin maxi. I've traded around Bitcoin like I trade around other speculative assets. Typically, if I look back at it, in the last 10 years, I've rotated between Bitcoin and gold and Bitcoin as that part of my portfolio. I think there was a moment where we thought the Bitcoin blockchain would have more utility to it, where there was opportunities to do that. People have tried to build smart contracts into it. People have tried to build around it. The decentralization does have value. And if you can find a way to harness it and you can find the right product market fit, Bitcoin, can have another chapter. Right now,
isn't the only product market fit though it being a store of value?
You can get to a place where it also stores information, where it acts as a record beyond itself.
No, but right now it is.
Yes,
like
there are other places it can go, and I would say a great trade would be to see Bitcoin continue to sell off, just as some of those use cases emerge, and then that decentralization come to the fore and catch the turn in that. As a speculator, you want to find like the right setup. We haven't locked and loaded yet on that setup, but that is a possible setup and one that I think is attractive to keep an eye out for.
So they're different, but again, bringing it back to like the core question is they're different, but they're not acting all that differently.
Yeah,
so
right.
why is crypto? I'll put some answers out right now. Why is crypto down when everything else is up? I think there's a few reasons. Well, at the simplest level, there is a lot of selling and very little buying, which seems obvious, but why is that the case? Okay, so one, I think capital is rotating out of crypto as a risk asset and into AI and chips and other risk assets.
Wait, I actually have a stat on that.
Okay.
Okay, so retail hit 20% of U.S. stock trading volume in Q3 2025. That's near a record high, and much of that is chasing all the AI names. And at the same time, all that retail participation was growing in the equity markets, chasing the AI names. Guess exactly what was contracting?
Crypto.
Retail crypto participation.
Retail crypto. And that's like, if you go back to what I said earlier about like the majority of like people buying crypto or buying it because they want it to go up, now they're looking at asset prices like Micron and these stocks that are having crypto-like returns, like 1,000%, 2,000%, 3,000%. And so people are just chasing that. Like a lot of them, didn't care whether it was Bitcoin or a stock. They're going to chase 1,000%.
Right. And Bitcoin, and not Bitcoin necessarily, but crypto broadly, took a lot of retail unaccredited investor demand. And so what you've seen now is unaccrediteds can obviously buy public market stocks.
Yeah.
And the same excitement that went into crypto is going into these. But for a long time, the speculation in crypto is I could get venture style, private market style returns whilst being an unaccredited investor, whilst being a retail investor, whilst being, anywhere in the world.
And while putting
And now
only $10 or $1,000 or whatever they felt comfortable putting in.
And now it's pretty easy around the world, or it gets easier every day around the world, to buy public market tech stocks that have 100 vol.
Yeah.
Well, but this comes, I think we've covered this on the podcast before, why crypto especially was exciting when we all got into it 10 plus years ago, is because for the first time, retail investors really had an opportunity to be able to get these outsized returns that were typically walled off to people who could pay to get into venture funds or have the wealth management platforms. So there's another stat when we talk about, actually, I bet this is part of your prediction, so I'm not going to throw it out yet.
Well,
keep going, or your theories.
Well, I
keep
think
going.
the next thing, if you look at why there's more sellers than buyers, a lot more, is people are rotating out of crypto into prediction markets. And
you want to know the stat?
Yeah, tell me the stat.
Okay. That's where I thought you were going to go. So prediction markets, I think, are very clearly absorbing speculative energy on this, because at this same time where I said retail hit 20% of U.S. stock trading volume, okay, in 2025, Q3 of 2025, Calcium Poly market monthly volume was $5 billion. 2 quarters later, it was almost $25 billion.
There you go. That's another way to turn a penny into $1, right? Yeah, or $1 into $100.
Or $1 into a penny.
Yeah, exactly.
But
That's
if you're chasing the dopamine hit of high returns and this crazy outsized venture returns, like people are now looking elsewhere outside of just crypto markets.
Yeah, and they're all things that like a normal person can like understand, like buying like Berkshire Hathaway and like trying to like go through their 10K and like figure out they're like a portfolio of insurance companies and railroads and like crypto and prediction markets, and it's just like it's very binary. It's just like
if you study
it's like
angel,
buying a lottery ticket or something.
Yeah, and if you study angel investing, of which I used to study a lot of angel investing, when you think about like building ecosystems around venture capital. Okay, so if you study angel investing, oftentimes the reason angels do investments, if they're not necessarily sophisticated like former traders or former financial professionals or whatever, the reason that they like to do deals is because they want to talk about them at dinner parties.
Right.
Like that is one of the top reasons angel investments happen. And angel investors even admit why they do angel investments.
Yeah.
And so you're not talking about Berkshire Hathaway at dinner parties.
Yeah.
I'm pretty sure Gen Z's not. I know millennials aren't.
Right.
Well, sometimes at dinner parties we do, but
100%.
not as much. Right?
I could almost always time the top. I didn't trade it.
Oh, damn.
Oh no, but not perfectly. By the volume of messages I was getting from my friends that I grew up with, who were electricians or working manufacturing or doing like normal like non like high financial jobs, the volume of messages from them around like, hey, should I buy this? Or like, hey, I bought this coin, or hey, and I would just be, oh, I was like Mark Baum in The Big Short.
Yeah.
It's a bubble. It's a bubble. So just because like I could just feel the speculative mania. I do want to, not now, I don't want to interrupt this flow, but because we should talk about will it ever come back?
It's important to
there's
ask,
definitely
yes.
something to salvage here, because like there's so much good stuff happening in this industry, and I think the speculation, we've talked about it on past episodes, speculation is not a bad thing. What's Clay Christensen, what's the term he talks about is basically having an industry that gets really big and blows a bunch of stuff up isn't necessarily bad.
Nope.
It like shakes things up, creates
creates a lot of capacity.
creative destruction.
Creative
Yeah.
Take the internet bubble.
Yeah.
You created a tremendous amount of capacity.
Yeah.
It just took 10 years to grow into itself. But by the time you got around to 2010, the biggest companies were internet companies.
Right.
So 10 years after the dot-com bust, the biggest companies in the world were internet-based companies.
Jeff Bezos was saying this the other day about the pharmaceutical bust. He was like, when everyone was doing biopharma, all of that life-saving drugs or whatever they might be still exist.
Yeah.
Right.
Even though the speculators lost their asses on it.
100%. And so, but let's continue to talk about why this is happening. So those are my
Wait,
like
what do you
main
think
two
about
reasons.
those? So what do you think about
But I think they're all real. I think if you had usage of the block space, you'd have brought in the investor base and the cohort and the economics to other stuff, and you just haven't seen it
So
yet.
you mean more capital would be more willing to flow in if they saw
if
real
you
fundamental.
look at hyperliquid, there's a lot of people trading perps and trading other things and doing stuff, and their token holds up great. When you see a blockchain that's got a $4 billion, $5 billion, $10 billion valuation, and it's generating $100 million in fees on a $10 billion valuation, so it's got to trade at 100 times network fees. That's a price that's going to go down.
Exactly. How it should work is like people use the network so much that it creates more buying than selling, because people need to buy the token to pay the fees. And then it creates an additional buying pressure because people are able to buy the token and stake the token and earn great returns from the validators because the validators are generating so much fees, right? That's how it should work. So like how this would be is like, all right, the whole world adopts Ethereum. That's going to be a ton of fees being paid in ETH to process all these transactions. That means running a validator is all of a sudden a very like profitable business. So a bunch of people are buying ETH to pay fees to process transactions, and that's meaning even more people are buying ETH to start validate. And so you create this flywheel of profitability. Yeah. That's what Ian's talking about. That's how it should work, but it's
100%.
Not. Right?
100%.
So what happens 100%. Now that there's hundreds of altcoins out there?
That's his argument. He's basically saying that there's so much capacity for, like, if you took all of the crypto transactions in the market and put them on Ethereum, the price would be mooning, because like it would be so overwhelmed with usage that fees would be so high that it would create, you see what I mean?
Right, but if you're sitting at the foundation right now of Ethereum, or you're sitting at, Avalanche, and you're trying to figure out how do we actually win in this world where there's like a lot of competitive pressure coming in and there's not enough demand to meet the supply of all that competitive pressure. What can you do? You can't really just like roll up.
Well, they're trying to generate demand.
Well, I do think you'll see blockchain roll-ups.
But how easy is that from a tech integration standpoint?
Look, you've got the
not easy.
Not easy. But that won't be what drives the roll-up.
So if you look,
yeah, of course. So if you look at all of the foundations out there, and look, this hasn't happened yet, but you can see this happening. If you look at all the foundations out there, and they've got big portfolios of applications and companies, and you said, we'll exchange your token for our token, we'll take it, we'll take the equity you've got at the foundation, we'll take the token, we'll take everything, and we'll just roll it up. And now we'll invest in getting those companies onto our blockchain, bringing their communities here. I need you guys to basically shut down your existing community, work with me to port them to our blockchain. And at these valuations, you could start to see that happen. I mean, it wouldn't be the craziest thing. I know a couple people have tried, a couple people have failed. That was a year or two ago.
Why did they fail?
Too early. People still thought they could make it work with their ghost chains, as it's called. The technology piece wasn't that easy. There's a lot of tech debt. People need to look, it's a recapitalization. It's a
Does
writing
it
of
also
things.
have to
It's a
do with
writing
all
of
these
things.
people already made so much money because of the way
100%
token
it does.
launches work?
Yeah.
They're already so rich.
A lot of the founders.
Most of these
but-
people,
but-
even
yeah.
if their
but-
chain is kind of shit now.
Yeah. Because they
Well,
dumped at the top.
Exactly, but you still have. So this is always what happens in any industry, in any asset classes. When you need a recap, you need to write things down. People don't want to write it down. People don't want to take the loss. People don't want to take the L and move on. Eventually, they do. Everywhere and always, eventually they do. And then a new cohort of investors comes in who figures out how to pick up the pieces of the brands, the failed brands or the failed tech or the failed network effects, and try to draw them together. I do think there's the 50,000-pound elephant in the room, though, which is if I'm going to go through the effort of doing that roll up and doing that, I have to accept that I'm competing now against some of the most cashed up corporations in the world that are competing with me to provide block space.
Okay, let's talk about corporate blockchains. Have we spent time on this? I don't think we've talked about this.
I don't know. I
podcast
think it's a
yet.
place Dave and I might not be on the same page. So,
Wow. I don't know.
What do you think?
what's your take on corporate L1s?
So you mean like a company like Base or like Arc?
Or Arc, yeah. Base or Arc now competes against Tempo.
Who's Tempo
Not-
again?
Tempo is Stripe,
Stripe?
right?
Yeah, but let's just take Base and Arc. Base and Arc are now competing against Ethereum and Solana,
Yeah.
right?
But there
Base-
used to be Hyperledger that IBM tried.
Yeah.
That really
that was
a big
that was
fail.
early though. I mean, the world's moved on.
Yeah.
The
'Cause that was a
world's
private blockchain.
Yeah, the world's moved on. These are public corporate blockchains. That's the question.
Yeah.
So if you're a public independent, let's call that Ethereum, and you're a public corporate, let's call that Base. Base has got a lot of capital to go compete now. It's got a lot of users on its other assets. It's got a network effect. It's got institutional support. It's got a lot of those things. Are they just too powerful to compete with at the independent L1 level?
I think that okay, so I don't think that there's one blockchain to rule them all because of the
Agreed.
trilemma. Every use case has a different requirement out of that trilemma.
And do you agree with me that a fourth, a quad level now becomes privacy?
Yeah, definitely. And so in that sort of multipolar world, I don't think that there's tens of thousands of blockchains. There might be thousands. There might be hundreds, a few big ones. But the corporate blockchains have a very different set of objectives, I think. And that means that they're optimizing for different things. We go back to when we talked about the three-layer model of sort of tokenization and stablecoins, where you have the settlement layer, you have the issuance layer, and then you have the application layer. You're seeing the issuance and application players move into the settlement layer and build their own blockchains because they want to vertically integrate and they want chains that are optimized for their use cases. So they want to capture fee revenue, so they don't want to give that fee revenue over to Ethereum or to Solana or what have you. They also want to build like Arc, you pay gas in USDC, right? And so like for a payments use case, you don't have to buy a volatile token to pay fees, right? And so you can make like a blockchain that is really good at like moving USDC fast and cheap, right? So like I think that they're not, because they have businesses outside of being a settlement layer. I mean, do they totally not care about the token price? No, I'm sure they want the token price to they want people to be buying the token to participate in the network and grow network effects, but like they're not living and dying on the price of whatever Tempo's token is or Arc's token or, you know what I mean? And so that means that they just have, I think that that's a really distinct advantage.
It's a big advantage.
But a big disadvantage is neutrality. So a lot of the reason, and we talked about this in past episodes, where like blockchains are really an answer to a collective action problem, which is how do you get all of these different parties to trust in the sort of public infrastructure, where you don't have one party that has like conflicts of interest and can exert control to the detriment of others. Those corporate blockchains aren't really very good at answering that question. Like USDT is not going to like launch itself on Circle's blockchain, or like Square is not going to launch like an application on Stripe's blockchain. And so in that regard, like their network effects could be quite limited because they have conflicts of interest. And then if their network effects are limited, then does that really kind of kneecap them? Because blockchains are incredibly dependent on network effects for value. So that's my thought. I don't know how it's going to shake out. I'm not smart enough to.
I mean, we come back to this trilemma issue, which is the independent blockchains have going for them decentralization and neutrality, and the market has not cared. And by the way, the market in traditional finance hasn't cared historically either. DTCC and, GSIFI banks and a couple major public stock exchanges. And, ultimately in traditional finance, users have basically said, we'll take speed and cost over decentralization, and we'll accept that there's systemic risks that come with that. And crypto was an outgrowth of '08 and the failures of that system. But very quickly, the market just said convenience and cost over resiliency.
That's thinking about success of these corporate blockchains as usage numbers, which is part of the fundamentals.
I think the only way to define a successful blockchain is usage. I think if we want to put sophistication into how crypto trades, yes, but that is not historically how crypto has traded.
Yeah, I mean, the marker for a chain success in the past, let's be realistic, is the price of the token.
But that, I think,
which are interwoven, but as we discussed at length previously, like that's not really what's driving a lot of the retail flows.
Well, usage is down, just to be clear.
Oh, yeah.
I mean, we're seeing usage down.
Because of trading being down, because the price is being down.
Well, unfortunately, the use cases that we made for all these independent crypto L1s was trading. Yeah. So we didn't build all these, like Web3 gaming never really has taken off.
Yeah.
I invested in Gunzilla.
It did and crashed. Like
what?
Bankrupt, wiped out the Philippines, like Axie Infinity. And some of those had really bad examples.
And Gunzilla was, I'm an investor in, and the game's great, and the guys are great, but that hasn't taken off.
What's it called?
Gunzilla.
That sounds cool.
It's a big Avalanche-based Web3 game, and
is that the one that's in Telegram?
No.
Or through the Telegram app?
Game.
Okay, so before we go down a Web3 gaming rabbit hole.
Yeah, let's
I'm just saying the other use cases never really came the way that people had hoped.
Okay, but let's talk about that.
So you were left with speculation on speculation.
Because I want to come back to relevance of crypto markets, because the big question is crypto trading, crypto speculation so relevant in the age of many more other places where retail investors can go and put their dollars?
I mean, yes, it's relevant, but it's not relevant in the way that it was. So Polymarket is Web3 based, right? To some extent. And Hyperliquid is a place where you can trade perps on oil. Hyperliquid's going up on weekends with Iran-US tension because people are using Hyperliquid as a way to trade oil when the oil markets are closed. That's a utility that a Web3 technology is providing, and the protocol is token price is benefiting from it, but it's not like Hyperliquid's going up because you can trade lots of because of meme coins, for instance.
Okay, so let's
Hyperliquid's going up because the product suite has diversified that can run on these Web3 rails, which is why I'm not bearish blockchain and I'm not bearish Web3, and I think that that's a secular growth story no matter what. And so where you do see demand and you do see utility in the technology like stablecoins, you do see the prices of those companies and those applications go up. But there, the usage is the driver. And what you haven't seen is enough usage for enough use cases in these independent L1s to support them when they weren't the locus of speculative frothiness.
I kind of look at this as like two hands pushing the prices. The more sustainable one that we all believe in is that the use case and the utility value is what drives demand and ultimately makes the market as a whole successful, whether that's price as a proxy or adoption as a proxy. And that's why I've been in crypto for a dozen years. I've lived through booms and busts. I've seen way worse than this. So let me say that. Like this is not bad in my opinion, despite what crypto Twitter would have to say. The other hand you have pushing and pulling is the speculation, right? And these things kind of aren't always operating in lockstep. And on the speculation, I for the same reasons why the sell sword speculators jump ship on crypto and went into prediction markets or into AI, they'll just as easily come back. Like,
Sure.
you know what I mean? Like that, this has happened so
But
many
that's
times.
if there's still venture type returns. So JP Morgan had a report and they said, this is their institutional read on the crypto markets. This was a few months ago,
Yeah.
so it's a little different now. But it said crypto's moving from a quote venture capital style ecosystem, which we already said earlier today, to a tradable macro asset class supported by institutional liquidity rather than retail speculation. So they're saying this is the maturation of the market.
I don't see institutions buying mid and
So is it
small cap
always
L1
only-
blockchain utility tokens.
Well, no. So then is crypto, like if the sell swords are going to come back into crypto, then they have to still be able to see that they're going to be able to make the type of returns that they could make somewhere else. So is the only way that crypto volumes get back to where crypto volumes were before is if retail comes back? Because you're saying institutions aren't going to come.
I think institutions can come, but not to the things that the retail was at. So it needs to redefine its. Now, by the way, institutions are going to get on Hyperliquid and trade oil on a Sunday if that's where the liquidity is. Okay, so institutions will go where they see the value proposition. I don't think institutions are going to go into buy Solana because they're pumped about a return of meme coin speculation. Like, I don't think that that's real. I do see
Not at any meaningful size. Like they might,
fine,
peel off a little bit.
right? But I do see a lot of institutional support. For instance, at Canton and DA, I do see institutional support.
Wait, by who's holding their token though, or just who's using their blockchain?
uses of
I
the
think
blockchain.
usage is different from when we're talking about like who's driving the asset price up.
I think it's, I think retail mania coming back in, as we've seen with all the other manias, like does as quick as anything drive volatility in both directions. I think institutions will continue to invest in Bitcoin. I think there has been huge outflows from the Bitcoin ETFs over the last few months, and that's put a lot of sell pressure into the market. And I think those institutions are just rotating out of Bitcoin.
Is MicroStrategy bullish or bearish Bitcoin right now?
You mean like, what does Michael Saylor think?
Just the concept of MicroStrategy. If MicroStrategy never did anything, would Bitcoin be higher or lower today?
Well, maybe.
Obviously, they own a lot of Bitcoin, so the natural answer would be it would be lower.
I think
if you didn't buy it all.
Let me first define like MicroStrategy for the listeners that don't understand what Ian's driving.
Yeah, if you've been sleeping under a rock for the last 5 years,
well,
maybe you
some
haven't
people
heard of
have.
it.
I mean, it's a really crazy concept.
Some people ignore crypto headlines because
altogether.
they're used
They're so
to
crazy.
the FTX or
Yeah.
whatever might happen. And so people are see crypto and they're like, not using my brain space.
So there are these companies, they're now called DATs, digital asset treasuries, which are corporate entities, some would say shell companies, whose business model is buying a cryptocurrency and then using a variety of different financial engineering methods to boost returns over what you would receive just by holding that cryptocurrency. So MicroStrategy is the most famous example. MicroStrategy started as a software company and it sold enterprise software. But today it holds tens of billions of dollars of Bitcoin. And so its stock trades fairly well in lockstep with Bitcoin. And it's historically, the value proposition was it demanded a premium over Bitcoin because it was basically allowing you to, it was taking on leverage. Like through, that's a oversimplification, but it was using some fairly complex financing techniques to raise capital, invest it in Bitcoin, and do that so you could make a dollar worth two, essentially.
And also, look, there was a time when it was hard to buy Bitcoin. There was a time when you needed to show up with a duffel bag of cash and find a really you had to invent a Bitcoin wallet in your college dorm room. Like now,
MicroStrategy
you can buy.
got
Now you
huge
can buy.
though when it was already easy to buy Bitcoin
No,
because BlackRock ETF
it's gotten
was
easier in the
already-
past couple. No. MicroStrategy was before the BlackRock
No, of course,
ETF.
but I'm saying what in this latest run up of how big they became. over the
I'm
past
not
2
sure
years.
that MicroStrategy didn't peak right around the time that BlackRock launched its ETF.
It was after, I think.
No, it's probably
From the amount of
in
Bitcoin
market
it was
time. It's
buying?
probably around the same time. So you can argue that MicroStrategy's ability to trade at a premium was 100% a function of the fact that more people could access a public market security than they could Bitcoin.
Yeah.
And now there are, to finish the point, there are hundreds of these DATs. And they don't just buy Bitcoin, they buy Solana, they buy Ethereum. Like people saw what MicroStrategy did and said, hey, this sounds pretty sweet. Like we can just set up this shell company and
100%.
buy ETH and like,
well, especially if you have a company that's not doing very well
Yeah,
in public
exactly.
markets and you're trying to insert something into
And
it.
that was the really interesting is people were taking over these like these companies that were publicly listed but were essentially dead. And their only value was that they were publicly listed.
Well, and now all those companies are trying to chase after AI data centers.
Yeah,
compute. Okay, so what were you going to say though? Land the plane on what you were going with is MicroStrategy more or?
I don't know. I mean, I think that one of the ironies is the best argument for Bitcoin is its decentralization. You have a guy here who's the most high-profile investor in Bitcoin who's trying to corner the market in it.
Wait, but how much
Like,
does
at some
think
point,
I heard
that's
he
like
only
the-
owns like 1% still.
Sure,
total
but his
of the
stated
supply.
ambition is to buy 2x the daily minted amount of Bitcoin, and he'll buy as much as possible. And if you take that to its logical conclusion, arguably the most attractive thing about Bitcoin, which was the decentralization, is hammered by the fact that there's one guy that has this much of the capacity.
Yeah, but he'll like the only way he gets to over 51%, which is how you can sort of exert.
No, wait a minute, I'm
control.
disrupting the network. I'm simply saying that if you concentrate enough Bitcoin into the hands of 2 or 3 or 5 holders, at what point does that just impact the concept of decentralization?
It does, but like no different than like the financial, like you have really rich people like Elon Musk who's worth $1 trillion and now exerts, you know, a tremendous amount of influence over it. So I don't think that's any different.
That's true.
I think the DATs, are they bearish or bullish to your original question? I think that they're,
Because mind you, Bitcoin was here 5 years ago.
I think they're like
Pre-DAT, pre-sale, or pre all this shit. 5 years ago, you had Bitcoin at the same.
BlackRock ETF.
I
You know
think
what I'm
they're volatile. I don't know. They're volatility accelerants. So if you think volatility is a good thing, then you should be bullish on DATs, that they're a bullish signal. If you think volatility is bad, both ways, that they introduce leverage into the system and they create tremendous amount of volatility. They help accelerate upward price movements, and they, like in the case of strategy, like in the GFC, Geithner talked about, like in his book, the financial Death Stars, he called them. So it's like BAML, AIG, Fannie and Freddie. Like the institutions, not everyone was sick, but there was a few that, like, if they went down, it was certain that everything else was going down, right? And strategy is like a big one of the financial Death Stars of Bitcoin.
100%.
Like,
Well, did you see what happened last week?
he sold like
$2.5
$2.5 million and it
$2.5
tanked the price, right?
absolutely tanked.
And
the
he's
price.
underwater now, mark to market, like $14 billion, right? And so, like, if he gets to the point where he becomes a forced seller into this market, like the price will go down quicker than you can imagine.
Yeah.
Right. But at the same time, his buying pressure has helped run the price up to where it's been. He's been it's a constant wave of buy orders in all of these order books.
He's obviously been exit liquidity for somebody.
Yeah. Oh, definitely.
And if you look at some of the older, bigger wallets, they did sell pretty notably around the last run up. So,
which was fairly new for a crypto market cycle, right?
Average entrance price right now is around like mid 55K. Like if you look at all the Bitcoin on the market, like the average entry price is 55K. So if I go around 50K, that's why people say like the real floor is 50K. If we cross below that, you have more people underwater than you have. And that traditionally, that's the point in which the bear market turns into a bull market. Because then you can put together a business case for why you might have a venture style return. Like if Bitcoin's at 50K and, you still have pretty well-known, analysts working for big banks who are giving pretty aggressive price targets for Bitcoin. And especially if you have a long time horizon, you'll start to see people buy back in and turn it around. But anyways.
I don't know if we have time, but I guess quick thoughts on the 4-year cycle anyways around Bitcoin, because that seems to be what everyone's talking about. And if we follow the 4-year cycle, then we're exactly in the cycle.
Yeah. There are like technical reasons that people will give for the 4-year cycle. I'm not sure if it's just a coincidence.
there hasn't been that much data.
Yeah.
The data set's not
What is
very
it,
large.
3 cycles?
data center's
Four?
not very large.
Yeah.
3 or 4 cycles.
Yeah.
So does that mean you don't buy
I just
into
don't
it?
think it's not wouldn't force me into be a buyer or seller one way or the other.
Yeah. Because it's kind of like you say, like, we have 10-year like bull bear markets in the normal, but like we've been on like what, a 20-year bull run now, basically, or 15. Like we're way overdue for like a huge correction or recession. And so it's almost like,
Knock on wood, Dave.
Yeah, knock on. Yeah, there's no wood around me, but my head. It's like history is not a map. I forget what the saying is. Like history is not like a blueprint for the future. It can inform like what might happen and teach you lessons, but it's not going to be something that you can, time a watch to. So,
All right.
well,
Did we answer the question? So if I had to summarize, I think what we're saying is there is still a place for speculative crypto trading, but we don't know at what volume it's going to be, and we don't know exactly what it's going to look like because of the competitive pressures from the thousands of alts out there, and on top of that, now new corporate entrants.
Yeah.
And when you have new corporate entrants, like that's something that's going to be really important to watch because they're the ones who have the flow right now.
Yeah.
Not flow from a trading
Yeah, yeah.
perspective, but flow down to the actual block usage.
I would conclude,
right?
we set out to answer the question, like, is crypto as an asset class still relevant in the age of AI? I'd say yes, it's still worth $1 trillion.
Well, crypto really hasn't done its best AI work yet.
Yeah.
Like we still have not seen agentic finance. If agentic finance winds up on these independent L1s, and they very well might, then you're going to see some of them are dead. You'll see some of them come back in a major way.
Yeah.
But we haven't quite seen that.
Yeah, the
product
founder
market
of
fit.
NEAR is on a tour right now, making sure everybody knows
bet
about
he
their
is.
AI strategy, which is an
is.
interesting one to watch too. Okay, so time to go to the signal, or anything
Sure.
else
Yeah.
we have to say?
No, I think it was good.
Okay. So as a reminder, the signal is using the theme of the episode. What are the few things we're watching specific to this theme?
I'll go first.
Go ahead.
So
You might have just given us yours.
the agentic finance piece, obviously hugely important. Bitcoin usage outside of being a store of value, hugely important. And whether or not the corporate-backed blockchains are able to win enterprise customers and institutional customers more easily than the independent L1 blockchains were able to. It strikes me that the corporate-backed L1s are likely to have pole position in providing blockchain solutions to enterprises and institutions. And so I think, let's see. We haven't seen any of those major wins yet, but I think you will by the end of the year.
Interesting.
I'm watching just mostly out of curiosity and to see if some of the things we said on the show were correct in terms of why we're seeing the behavior in the markets that we are, is the SpaceX, Anthropic, and OpenAI IPOs and how those go and what crypto prices do in relation to how those go.
Yeah.
So like if those go well and crypto continues to go the opposite direction and be the drunk in the street stumbling around, one of my assumptions, because again, if we knew any of what we talked about today for certain, we'd be running a hedge fund, or like we wouldn't be sitting here on a podcast. We'd just be trading our own prop capital.
Mean Ian, who has run a hedge
Yeah,
fund?
exactly. Yeah.
I mean,
Yeah. So that would be to me a strong sign that it really, like, the capital rotation out of crypto and into AI is a real driver of price action in the markets.
Mm-hmm.
I'll take a different approach because everything y'all said is covering also what I'm watching. But something you said earlier made me think about this, Ian. So you're talking about corporate blockchains. They already have the customers. And they're saying, let's build the blockchain because we can then we can send demand onto the blocks. Well, as we all know, there's also a bunch of L1s out there that are fighting for their life for survival. And what they're saying is, why don't I actually build take it on myself, build applications. Remember, that used to be a big no-no.
Yeah.
Like if you were an L1 building your own application, people are like, but you're going to be competing with your community. There are many reasons why a lot of people didn't really do that. And now
there's been a lot of bad decisions made at L1 foundations.
Well, because L1 foundations are not business people for the most part. They're getting better and better and better. But let's talk about like 2020. The people who were running those foundations, they were like crypto degens for a lot. I'm not speaking about everybody,
No, for
but most
sure.
of them,
Yeah.
right?
Yeah.
So they don't know how to build early stage venture companies. And that's what it took to build the right applications on top of these. But
And-
now
and they're
you're
still-
seeing that happen a lot more where these L1s are like, okay, if Stripe is launching and Circle's launching
Yeah.
a blockchain, and they're going to be competing now in my space, and I have to figure out how to compete in their space. And so there's a lot of new L1s that are launching their application layer, and I'm really interested to see how those go.
That makes sense.
So
Great episode.
Great
guys.
episode, guys.
Good to be here in person.
Amazing.
Yeah.
Good to see you guys.
time to go have some beers.
Yeah.
Thank you very
Okay.
much.
Yeah.
Go
Bye,
next.
guys.
Bye.
Thank you for watching Money Moves. I'm Samantha Lewis.
I'm Dave Sutter.
I'm Ian Epstein.
Don't forget to like,
Subscribe.
And comment.